You have a bookkeeper doing the books for your business. You know transactions are being entered into QuickBooks, and you've seen reports. But how do you know that it's being done right, and that the reports you're looking at, the reports you're giving to your tax accountant, are a true reflection of how your business is performing? In this video, I'm going to walk you through 7 ways you can check your QuickBooks account today to verify that your bookkeeper knows what they are doing, that your books are being done right, and most critically, that you are not paying thousands of dollars extra in taxes each year for their lack of experience and training. Follow along as I walk you through the 7 steps. Be sure to stick around for number 7, which is the most critical, but also the most commonly missed error made by inexperienced bookkeepers, and the one that can cost you thousands of dollars personally out of your own pocket every year in taxes. Number 1. Are your reconciliations being done regularly? Are they up to date, and is every credit card you use for the company being reconciled, and all company expenses for your business being captured? To check, go to the gear icon at the top right-hand corner of the screen. Click on Reconcile, and then Summary. From here, you can see a complete listing of every bank account, credit card, and loan currently on your company books. First, is the list complete? Is every credit card and loan associated with your company on this list? If not, then you're missing interest deductions that you could be taking come tax time. Next, look at the dates. These dates represent the last time your accounts were reconciled. The dates here should reflect the date of the most recent statements issued from your bank. If the accounts are not being reconciled in a timely manner, the risk of expenses and revenues being missed dramatically increases. We often see that bank accounts are being reconciled on a regular basis, but that credit cards and loans are left unchecked, or that certain credit cards used for the company are not even on the company books at all. Every account associated with your business should be on the company books and reconciled every month before reports are issued. Number 2. Is your balance sheet being analyzed every month for errors? A lot of business owners are concerned with the bottom line, and rightly so. Often, a business owner will flip right past the balance sheet and straight to the income statement to look for profit or loss, and never give the balance sheet even a cursory look. A good bookkeeper should be looking at the balance sheet for you. A good bookkeeper will understand that if the balance sheet is wrong, then the income statement is wrong as well, and that means your profit and loss line is wrong too. Let's take a look at what a good bookkeeper would be looking for each month as part of the financial review. Negative amounts in the asset and liability accounts. Negative bank balances on the balance sheet when you have a positive balance at the bank is a red flag. This could mean that there are errors in the dollar amounts of items in your register or outdated checks that need to be voided. Negative assets or negative liabilities. This means something is wrong. These accounts should not be negative. If you see negative assets or liabilities, then either something has been entered wrong or there are missing transactions meant to offset these negative amounts. Number 3, are there missing or outdated assets and liabilities on the balance sheet? We often see loans sitting on a client's books that have already been paid off, or fixed assets that have been disposed of long ago. Sometimes we discover fixed assets being paid for by the company that have been miscoded and not showing as an asset on the balance sheet at all. Getting outdated loans off your books and correcting your fixed assets will improve the financial health of your company books. If your bookkeeper is not asking you about stagnant asset and liability accounts on your balance sheet, then they may lack the experience and training required to maintain the financial health of your books. Number 4, outdated accounts receivable and accounts payable. Depending on if you run your business as cash or accrual, these accounts may or may not show up on your balance sheet, but direct reports should be reviewed each month for accuracy and completeness. To check accounts receivables, go to Reports, Standard Reports, Who Owes You, and Accounts Receivable Aging Summary. You want to look at the oldest columns. Ask yourself, can we reasonably expect to collect on every invoice listed here, or do some of these need to be written off? Next, look for any negative amounts. Negative amounts are indicative of a payment made that has not been correctly attached to an invoice, or an incorrect duplicate of payment that needs to be deleted. To check accounts payables, go back to Reports, standard reports, what you owe, and accounts payable aging summary. Again, look at the oldest columns. Ask yourself, do we actually owe these outstanding invoices? Or have they already been paid and the payment was either not properly attached or is not entered into the system? Having outdated or incorrect payables and receivables on your books can overstate revenues and understate liabilities, which skew the profit and loss line and render your financial statements useless for financial planning and forecasting. Number 5, are journal entries being used unnecessarily to record daily transactions? While journal entries have their place, and there's definitely a time and place to use them, they should not be where the bulk of the transactions for your business are being accounted for in QuickBooks. QuickBooks has all the processes for business accounting automated in such a way that journal entries should only need to be used for corrections and adjustments sparingly, usually only at month end or year end, and by an accountant who knows what they are doing. From the dashboard, click on the plus sign and go to Journal Entry. Then click on the review icon in the top left corner. This is the list of the most recent entries. Review the list of entries. There should be maybe 1 to 5 journal entries a month, depending on your business. If you see a lot of journal entries here being done in a month, it doesn't necessarily mean your accountant doesn't know accounting, but it does mean that your accountant doesn't know QuickBooks very well and is doing bookkeeping in such a way that makes it very hard to find mistakes in real time and fix mistakes in the long run. Number 6, is your income statement being reviewed each month for inconsistencies? Go to Reports, Income Statement, and pull the income statement for the year to date. If it's early in the year, pull it for the prior year to get a more complete picture. Scan each line. Do you see any gaps? In a normal business, most expense lines on the income statement will be fairly consistent in their dollar amount from month to month. If you see a gap on a line, that could be an indication that the expense was missed that month and is not accounted for or not accounted for correctly. Now scan each line again. Do you see large jumps? Large jumps can be explained when unusual expenses or a unique event occurs in your business, requiring a change in normal spending. However, large jumps that do not have an explanation should be researched, as chances are something has been coded incorrectly. In the prior rent scenario, we saw missing rent payment for May. In this scenario, we now notice a larger than normal expense in May under equipment rental expense. A closer look leads to the discovery that rent has been miscoded, skewing both the rent expense and the equipment rental expense lines. Finally, scan your account names for odd or ambiguous accounts. You never want to see ambiguous names that a myriad of expenses could be hiding in. Examples we've seen in the past have been expenses such as miscellaneous expense, American Express expense, or uncategorized expense. The purpose of financial statements is to understand where your money is going each month, so you can make management decisions based on where money will be spent in future months. Every expense for your business should be properly assigned to an account that clearly expresses what the expense was for. Unclear account titles and catch-all accounts do not help management's understanding of where money is being spent and hides potential errors and fraud. And finally, potentially the most costly error of all for you as the business owner is number 7, are owner drawings or distributions being closed out each year? Most U.S. businesses are taxed as a pass-through entity. This means that taxes are not assessed on the net profit of a business by the business, but instead are personally paid for by the owner on the amount of owner drawing for the year. At the end of each tax year, QuickBooks resets all expense and revenue accounts automatically. However, the one account QuickBooks does not reset is the owner drawing or owner distribution account. This account needs to be adjusted with a journal entry manually on the first day of the following tax year to reset it to 0. If this account is not manually reset, then it just keeps accumulating, making it seem as if the owner is taking exponentially more in drawing each year than they are actually taking. This is the number your tax accountant is looking at to determine how much taxes you will owe for your business income. If this number is not being reset, you could be overpaying your taxes by thousands of dollars each year. To check to see if your bookkeeper is making this adjustment each year, go to your balance sheet, find the equity section at the bottom, and click into the owner drawing account. Go to the top of the screen and change the reporting period to this year, and then click Run Report. This will list all distributions for the year. Go to the balance column. The beginning balance will show what the owner draw total was as of 12/31 of the prior year. The next entry you should see is a journal entry for the amount of the beginning balance, setting the account to 0 for the new year. This journal entry shows that the drawing account has been reset to 0 and ensures that the drawing account in the current year does not include drawing amounts taken in prior years. If this account has not been reset for the current year, then chances are it has not been reset in prior years as well, which means you may have been overpaying on taxes for years. While these 7 steps I reviewed are not exhaustive by any means, they are a good quick check on whether your bookkeeper is doing a good job and if they have the training and experience your business requires. If you've made any uncomfortable discoveries during this process that concern you, or if you would like a more complete review of your books, we offer a comprehensive financial review as a free service at Centricity Accounting. Go to centricityaccounting.com/financial review for more information, or email us at info@centricityaccounting.com. Peace of mind is only a click away. Centricity Accounting. We focus on your books so you can focus on your business.